Hey everybody, this is Bob. I'm good friend Phil here at Trade Genius Podcast. Do you ever play the game Jenga? Well, we're going to show you how to play stock market Jenga, and you're not going to want to miss this because we're about ready to pull the last plank out. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Phil, we've been talking banks, but I think we have something really interesting to show people how you and we can use this banking information to be able to make money in the stock market. You want to share what you got there?
Right. So today was, I think, a little sampling of what's to come with the banks. And, a lot of the issues that are been brewing for the last weeks and months, are starting to, I think, rear their head. And, the markets know, if you wonder, like, well, why did the banks sell off today? Because today was a pretty broad sell-off in all of the banks. And it wasn't just the regionals either, but we'll start with the regionals. But, people know, right? People know that things are coming to a head and it's time to get out. And I think getting out ahead of the FOMC as aggressively as they did today was a telling. I think we'll probably be in a holding pattern, range bound into tomorrow's announcement, but I expect fireworks after tomorrow's announcement, and we'll see what happens in the initial directions. I think ultimately down. But here's some regionals that really got hammered today: Western Alliance Bancorp, Zions Bancorp, Charles Schwab Corp, Huntington Bank Shares, and PacWest Bancorp were some of the notable drops today. And we'll get into what the index is looking like too for the regionals, because that's really important for the stock market and your portfolio, because it's a great leading indicator. But we'll get into that in a little bit. And it wasn't just the regionals too, Bob. The big boys got hammered as well. And, this kind of just, when I look at this stuff, I just think contagion, and the banks, you need the banks participating in a bull market. And that's not what we're getting. The banks are telling us that we got a heavy bear market starting here. But this was JP Morgan, Bank of America, Goldman Sachs, Citi, Wells Fargo. I mean, these are all your GSIB banks, and they're all just getting hammered. Okay, so this is a serious problem. Okay, this is going to be, when we say contagion, I don't say that lightly, but this banking issue is a big problem. And the biggest reason why is going to be because of the CRE exposures. CRE means commercial real estate. So here is a matrix or a grid of the banks by their stock symbol names. And if you are in that yellow zone, you're probably at risk of failing at this point going forward. And the reason for that is just because of the percentage of their holdings as a percentage of their average earnings, okay? And so everybody from CADE on down is in trouble here. NYCB, Bob, looks like probably has a lot of risk here with 57% of their property type exposure as a percentage of their average earning assets, 57% in multifamily and residential, non-income producing and construction, 34% by OZK. I think that's Ozark. SBNY, 18% in that multifamily. So there's quite a bit in that multifamily area, which, at this point with the housing prices that went way up, those are going to come down, and those are going to be problematic when the assets start falling and it affects the LTV or loan to value ratio. So there's pretty significant problems here, and the Fed's probably going to have to use all 10 fingers and all 10 toes to plug all the holes in the dam here, and then some. Yeah, and then Bob, I wanted to flip over to the KRE chart here, which is the SPDR Regional Banking ETF. And you guys are looking at a weekly chart here. Basically, what I wanted to point out was that you are looking at a leading indicator for the stock market. If you notice that when we went into COVID, KRE started rolling over first here, and then the S&P 500 caught down to it. And that was, COVID significant crash. If you look at this chart here, it doesn't look a whole lot different than the price action that's going on right now. We're over 50% down from the highs here from the beginning of 2022. Okay, so this whole complex is crashing, and the S&P 500. The only reason why this thing's been up here is because Yellen's been feeding liquidity into the system, fighting the Fed's roll off, and the banks too, because the bank repo levels have been grinding higher as well. They're not stupid, they know. But the point being is that you have to pay attention when the KRE starts to diverge away from the S&P 500. The S&P 500 is this black line we have overlaid. KRE are the candles, and you'll notice that when we started getting into the end of the bull market, going into 2022, we started to see these cracks, we started to see these divergences, and then everything started to roll over. And here we've got another situation where you're seeing it here, where a KRE rolls over, S&P 500 is holding up, and now we've got a massive break, massive divergence, and never have we ever seen the regional banking sector crash and the S&P 500 not catch down to it. So I think, Bob, and I know you can speak to it, is that with everything going on, you'd be crazy to be buying stocks here.
Yeah, and I know you've been pretty cautious waiting till after the FOMC meeting, but I think today we had our first vibration of people getting a little nervous on top of Yellen saying she needs to borrow even more money than she initially expected, and she needs to have the debt thing wrapped up earlier than she originally. I think that sent some shockwaves through the system. And today we actually had a liquidation day, Phil, because we had oil. The whole energy complex went down. I think the only thing that was up today was gold and silver miners and the Bitcoin miners. So a little bit of comfort there. We'll see if that holds through on a full-blown, destruction move here after Powell raises interest rates another, 25 basis points and has hawkish guidelines going into the summer. So we're still of the opinion that we may even get another move in June unless we get a stock market crash between now and then. And I think the Fed, honestly, Phil, is waiting for a crash to stop going higher. I think they're waiting to see if behavior is changing. And so this might be the move because seasonality tells us, going into May, into June is weakest. And
Right.
And with all these things piling up on us, I not even a fool to be going long. I think you're foolish to keep a lot of position now. I think you should have been trimming for the last couple months because the market hasn't really been going anywhere, so that you can have dry powder to be able to buy back in, after some of these earthquakes, because we'll get another bear market rally after this move down.
Right.
And then we'll get probably the fall move will be just like 2008, where it'll be the waterfall.
Agreed. And you haven't been wrong about energy. I mean, if you look at the market top, right, energy has been your safe haven, basically. Here's a weekly chart. Black again is the S&P 500. You can see the top of the bull market pulls back, and energy just outperformed the whole time. But like Bob said, you got to be careful here, because when this bear market rolls over and when you got the KRE index screaming at you, everything's at risk. Bitcoin, gold, energy, right? So, you have to kind of follow along and not just be like, whoa, Bob said energy's safe. Well, you got to take it in context. And we've been saying Bitcoin and gold has been a good play too, but I'm a little leery here on these assets, Bob, because I just think that, how it goes. Once the bear market starts to roll over, everything gets taxed.
Yeah, and in fact, my energy position, I remember I was telling you guys, I don't know if it's been a week already, but I had a little bit of a nightmare on what I think is going to happen in energy. And it has been weird. They've been holding it up. But today last 2 days, they just let this thing just go. And you can't avoid it. ExxonMobil had incredible earnings, and they dumped this thing 11% without even blinking. So you got to be careful here. And, I'm taking steps in terms of selling against my position with covered calls, lightening my size. My trading account is going to be leaning almost totally red going into this Fed meeting, and just got to be really careful now, because the indexes might only go down, let's say 10%, but your portfolio will be going down 20% just because of the nature of the way these indexes work. The underlying always falls farther than these indexes because the nature of the market cap stuff, until we really start to sell off. And then the indexes will outperform to the downside your individual stocks. But I've been going through the trades that we've been making, Phil. If they're larger cap stocks, we've been doing great. If they're smaller cap cap stocks, they'd be getting their heads handed to them. They can't make a trend. And that means they're being abandoned by Wall Street.
Yeah, and I think you have to take notice too when you have a name like Exxon doing these multi-day gap downs and big red candles, and that's all you need to do is look to the left when that starts to happen. And these moves usually aren't just a couple days long. This is like usually where we get our tops and then things start to roll over. And the market does not ignore energy. Energy rolls over. See, you guys got to keep in mind too, in bear markets, 90% of the time in major bear markets, energy is the last thing to capitulate. Okay. So for it to be already starting to roll over this aggressively, and technically we haven't really gotten into like the real meat of the bear market yet. Okay. But we're proposing to you, as we've been saying over the last few weeks, that is to come. And I think we're starting, like Bob said, I think you saw the first shot across the bow of the real move here coming up, kissing 4,200 and then rolling over. Due to the nature of the way things are hedged going into FOMC, you can actually go get the announcement, actually see a bit of a lift after the announcement, and you think, oh, everything's okay, and you might even get a little bit of a sympathy rally on the regionals. But make no mistake, that's just a momentary release of hedges that creates this artificial lift. And it seemed like things are okay, but nothing has changed. The banks are in big trouble. Their commercial real estate exposure is going to be a cancer on the whole system, I think. And we're at real risk here, guys. So I just want you guys to be very, very careful going forward.
And with that, guys, hug your children, take your wife out to dinner, and strap in for a wild couple weeks with the market.
Agreed. All right, guys, thanks for watching. Please hit like and subscribe. Smash that notification bell. Set it to all if you can. We'll see you on the next video. Take care. Bye-bye.
Trade Genius.